Guys, I want you to leave Nike short. I think we can get it to 84, and then we can see if you want to grab it there. But I'm not touching it re-short. Not yet. In fact, don't even short it yet. Like, don't even look at it short. At that 84 level, it's got a little bit of strength right now. Don't touch it. Don't touch it short. Okay, guys, we're going to leave Nike alone, but if you want to grab some at 84.50 short, you can grab a starter right here on the short side, $84, and then you want to get it back to about 83. You can cover some into that. I'm going to pop the screen share back up, but we're not going to be looking at the Nike right now. Okay? You guys can see the screen now? You should be able to see the screen. I'm going to get the voice channel back up to general. There you guys go. Everyone should be able to see me.
If you guys want to.
Okay, guys, cover that Nike. Oh, sorry. For the people that are taking it short right now at that 84 level. It just pulled right into that 83 like you wanted. Cover into that 83, break the 83. You should get it back towards that 82.50 area. That 83 is your support for now. Mental stops would be at $84, right at your average. Don't let it get past that. But 82.50 is what you're looking for. Broke that 83, should go towards there. There you go. Make sure to be scaling out as it just falls. Anyways, so we're done with that.
Hey, Dylan.
So anyways, let's talk about risk reward, guys.
I got to reset my chat.
Taking the one-on-one webinar, you know exactly what I'm talking about. This is something that I go over on every single webinar, but now that we have people in the chat room, this is something that I think is important to talk about and explain how it works, because if you're going to be trading, day trading that is, you need to understand basically the fundamentals.
If you guys want to help out, you could share this stream on Twitter or Instagram or Facebook or whatever your social media is.
That's one of the only things
this should be a pretty good
in the market. You can't control the market itself. Obviously, the market's going to do what it's going to do, but you can control where you enter in the market.
I'm going to mute the Discord, so if anybody's talking in Discord, sorry.
The whole point of risk reward is to be making sure that every single situation that you're putting yourself in has more upside potential than downside potential. We always know where our stops are going to be. It's a little bit harder to figure out how much room a stock has to the upside, especially if you don't understand technical analysis. But we can use technical analysis to find, areas of resistance to the upside if we're looking to go long on something, and we look, and areas of support if you're looking to go short something. So, what this spreadsheet is this spreadsheet is an explanation of risk reward. Again, if you guys are in that one-on-one, you're going to know what I'm talking about here. This is something that I preach every single time I go through it. I want you to focus at two areas. I want you to focus on up here, max loss per single trade. This should say minimum profit, but it says max profit. So minimum profit per trade, which is, what you're trying to be looking to make each position. Risk reward ratio is right there. So this calculates your actual risk reward ratio.
I will be doing that, Steve-O.
Basically a simulation of a year's worth of trading, 5 trades per day, which is pretty standard for a day trader. Some people do more, some people do less. I tend to do more. This simulation, the only thing that can be controlled in it, the only variable in that simulation is the actual risk reward ratio, is where you're putting your stop and then what you're potentially trying to make to the upside. The probability of these trades working is completely random. And that's important to know. It's completely random. There's 50-50 shot that these trades are either going to work or they're not going to work. In trading, obviously, we tend to take setups that have higher probabilities of working. For instance, like a 10-minute flag break with a candle closing above that downtrend to the upside tends to have a higher probability of pushing than not. But this is just for this example. This is a 50-50 probability of the trades working. So really the only thing that we can control in the simulation is the risk reward. Commissions are not calculated here. But anyways, I just want to show you one thing, a couple different things actually. Let's say, just for argument's sake, you're trading 150 shares per trade, and you're always risking 1 point to make 1 point on a trade. Every single trade that you're taking, and a lot of professional traders are going to understand risk reward, and this is nothing new to them. But for the newer individuals, you're taking.
I think I'm gonna share it on Twitter as well.
And every single trade, you're risking 150 shares, and you're trying to make 1 point. So you're risking 1 point to the downside to make 1 point to the upside. Every single trade. This is the entry area. If you're constantly taking a trade and risking the same amount that you're trying to make every single time at a random probability of success, which we know it's not going to be, what's going to happen is over the course of time, your profitability is going to be nil. You're not going to make any money. You're going to be negative with commissions. Just watch that yearly profit running through that simulation 5 years.
Yeah, Spartan Trading is paid.
Obviously at the random probability of the trade working. But what happens when you start skewing just the risk reward, still having a random probability of the trade working in your favor, just a little bit. So now the risk reward ratio becomes 133/1. You'll notice that the profit is constant. Even at a random probability of those trades working. As long as that situation is skewed in your favor, over the course of time, you're going to be profitable. Once you start skewing this even more and more and more in your favor, the profit, will go up exponentially. You can see it obviously it jumped exponentially. Now, the biggest thing in this is, in theory, you can understand why risk reward is so important. This just demonstrated it to you. But one of the biggest things is when you're actually live in the trade is allowing those trades to run into your your potential first price target of that 3-to-1 goal, and not letting it. Sorry, this is bad writing, but not letting that loss get past this area. So what happens is this takes extreme discipline, and that's the hardest thing in trading. Obviously, it's all emotions. The technicals are, in layman's terms, pretty easy to chart out once you know what you're doing. The hardest thing is to let the things run. So let's say that every single trade that you do take, you're making sure that, for argument's sake, you're looking at flag breaks to the upside. And every single trade that you're taking.
If you guys have any questions, ask them, and I'll relay them
in your favor in terms of the setup and where the next resistance level is. The hardest thing, and one of the things that I notice with a lot of traders when they do trade, is they cut their winners off early. They'll let the trade go up, and let's say they make the $150, even though they were trying to make $450 on the trade, and they see it has 3 points of room to the upside on 3 points of room to the upside on that 150 shares. But every single time they get up $150, they end up taking the profit regardless, just because emotionally they want to lock in those gains, whatever. They got to understand that if you keep doing that in the long term, it's going to ruin your profitability. It's going to ruin your risk reward ratio. We need to let these things run, scale out as it's moving, and let them go into your targets and then go past your targets. We're charting out the first resistance level. It doesn't mean that the chart's always going to get there. Certainly won't, but it has a higher probability of pushing into that level because there is no resistance till it hits it. The other thing that I see is they're not disciplined on their actual risk amounts. If you actually want to have this risk reward ratio a true 3-to-1, you can never let it go over your max loss amount. Every situation is different, I understand, but you can always get into the trade lower.
It's not about position size,
Think about it as a new trade. Once you hit that risk
depends
level,
on your portfolio size.
Think about it as a new trade. You cut it off. If you want to get into it,
ideally you want $100,000 because that's just 1%.
Let's say basing occurs, it breaks the range back to the upside. This is a new trade. Then make sure that risk reward makes sense again, 3-to-1 at least to the upside. If it works, great. If it doesn't work, then we'll move on to another trade. There's always going to be another trade out there. Never average down into losers. You should always be taking
I've done that.
size.
Don't do that.
Quarter. If that one quarter doesn't work and you get stopped out, not a big deal. You never want to take full size on a starter position and then you get stopped out.
A couple different ways, Steve-O.
The positions, you're going to be able to give it more room to work. Once it starts to work and starting to push up, that's where you want to start adding into those.
My calculator,
by the way, Nike's
which you can download in the Discord,
It did hit that 82 target.
This right here.
Watch it under
this is the amount of shares you have for the stop loss that you're using.
Continue to sell off.
So if I buy a stock with a 30-cent stop loss, which is 143 shares,
so
if the stock moves 30 cents,
the question then becomes, okay,
my way, I make 1-to-1 trade. If it moves 60 cents, I make 2-to-1. 90 cents, 3-to-1. So that's a quick way to do it.
Something that people don't
dollar amount wise.
Talk about risk reward, but they don't demonstrate actually how to do it. This would be, trading criteria. Let's say, based off of your account. Let's say you have an account of 25K, so like a normal day trading account, 25,000. But each trade that you take, you're only comfortable putting, max. And let's make this a little bit lower, just so that for some of because this is obviously for the newer traders. Let's say that they're trying to make $250 per trade. They're risking $100 per trade. They have a 25K day trading account, and they're only comfortable, let's say, putting maximum amount of capital in each trade, 5,000 per trade.
You can't predict that, Garen. You just have to know your accuracy.
An account like that, you got to build yourself some sort of criteria. You don't have to stick with this criteria that I'm putting out right now. I mean, you have to have
signals or a strategy that allows you to get out if the trade doesn't go your way, but you still make profit.
You can kind of see what we're looking at here. So let's say that I had a
account,
with 25K, I'm only comfortable putting 5,000 into each position. Profit target's always going to be looking for.
Yeah, I'll do. I actually might shoot that tonight.
Max loss is always going to be negative 100 shares. This is how you got to be thinking.
Use my fancy new mic.
Is when you see a setup. So let's say, again, flag break to the upside or a range break. I'll bring up an example.
Up to 105 viewers.
If you have no idea what I'm talking about, you'll just have to, just start looking up basic technical patterns, etc., like that. Looking at a flag break to the upside, the first thing that we got to do before we not only look at the setup and make sure the setup is good, we got to look at the risk reward. So in this case, if I see a flag break to the upside, I got to make sure that from this point, there's enough room to the upside in order to meet my minimum profit target goals. So if it's a $10 stock, I need to see at least 50 cents.
I used to watch UFC a lot. I don't know.
If I go full size, so that I can make minimum my 250. We always know where our stop's going to be, so that doesn't matter. We always know where our stop's going to be on our full size and on our scale size. But we got to make sure that the risk reward is skewed in our favor in that situation. Let's say you're looking at the stock and it was a flag break, but the next resistance level, and the stock's at $10, the next resistance level is at $10.30. Does that meet your risk reward to the upside? If you're going to be risking 20 cents, you only see 30 cents of room to the upside? No, don't get into that situation. You may go, oh, hey, it can actually break that 30 cents and run more. Yeah, it could, but there's going to be other situations that you can control better by making sure that they already have that room. You don't know if it's going to break that resistance level or not. All we know is that's where the next resistance level is. It could have room to there. There's a higher probability.
No, you have to know your win rate, your strategy, but you have to track your win rates.
That has minimum your.
Nobody can tell you what your win rate is, but you.
Let's say that, the position, it's a $10 stock. It has, for argument's sake, 75 cents of room to the upside. What you want to be doing is obviously starting with your starter size, right? Take your 125 shares, usually starter size, just for ease, is a quarter of your full size. Full size is 500 shares in this example. Take your starter size, 125 shares on that flag break. Let's say the flag break starts to work. And the reason why you would take starter size is if just in case it gives you a little bit of a head fake and it ends up pulling on you, you only get stopped out on your starter size, not a big deal. So 75 cents of room to the upside. You take your starter size, 125 shares at $10. As it starts pushing up, let's say you break, 10.15, you go, okay, I want to add into this position full size. I want to take, I want to add into it another 375 shares to make it the full size 500. At that 10.15, you still got to look and go, okay, does it still have, minimum 50 cents of room to the upside? From 10.15, well, it's got room to 10.75.
I'm pretty sure it can't. That's why he wants 3-to-1.
Yes, that makes sense. I'm going to add full size into that position. Obviously, then you move your stops up. You're going to have a little bit of cushion from that 125 going up 15 cents to the downside, which is fantastic. And then you just let it run. You don't be, you want to be scaling out as it pushes. Take off a quarter at a time. But typically you want to let it run into resistance level or let it run until it breaks some sort of trend to be getting out of. But that's the basic concept of risk reward and why it's important. You need to be building some sort of criteria for yourself. You got to be making sure that the situations are skewed in your favor before you get into them. If you're unsure of what the situation is, then obviously you should brush up on your technical skills, because that's the main way to figure out how much room something has to the upside or the downside, and also how to recognize breakout patterns or patterns in general, breakdown patterns. It depends upon if you're going long or short. Intraday, if you're going to be day trading. This also works on swing trading as well, but obviously when you swing trade, you want to be reducing your overall size, because you're probably going to have to give it more room to breathe. Chat's asking, how do you not let emotions get in the way? So this is the fundamental reason why this criteria is important. This loss amount, and this takes time, and over time, you're going to have to adjust this as you go. But this loss amount right here has to be so small that if you do hit that max loss, it does not affect you mentally. So
very important.
Maybe $100 is too big. Maybe you can go up to 500. Maybe you can go up to 1,000. It depends on
how much can you tolerate
and how long you've been trading. But as you trade longer, this is going to increase. You're going to go, oh, it's just $100. Okay, whatever. Oh, it's just, $250. Oh, it's just $500.
Today I did 5 or 6, Alex.
Because if you repeat this over and over and over again, you're going to be profitable regardless. But as you start, certainly you got to have the smaller amounts. It has to be an amount where you honestly are not affected mentally if you take that loss. But yeah, I mean, that's the basics of risk reward. So that's, something that I want to talk about with everyone in chat. And then I got Garen to stream it because I think this is good information just for everyone to know about. Yeah, just wanted to quickly give you guys an example, because people always talk about risk reward, but they don't necessarily explain it or demonstrate, how you can apply it. Good question by JC. If we scale in while the trade is working, how do we manage if it turns around on you? Stops, break even, or give it some room? You never let the green trade go red on you. Let's look at an example. Okay. Let's go to AMRN would be a good example of this. Let's go to a 10-minute. So AMRN, when it broke $13, which was the range from yesterday, and by the way, this is a, let me just blow this chart up so you can see it a little bit better. This is basically a bullish pattern.
Thanks, Dylan.
A range break is when something trades within a range and it breaks that range to the upside.
Yes.
What happens is
he's cool with RXN.
The next resistance point on the daily. So when this thing broke the range today, the first thing that I said to everyone, AMRN's breaking the range. And then I went back to the daily. And then what I had to do was I just had to check out where this stock had room to on the daily. So this thing broke that $13 area. I saw on the daily, okay, it's got room to 1384. That's the next resistance point. So I just went 1384, next resistance point. And then just for ease, we're just going to chart the next one after that, which is about $14.93. Okay. So first thing that we do is we chart that resistance point on an actual setup breakout. So let's just go through the steps. And we'll use that risk reward I just created. So the setup, we got a range break. So the setup is good. And let's do this to where it actually broke out of the range. FYI, guys, when you first start, you should be charting out the risk reward intraday. Try to not focus on it during the morning, because you just won't have enough time to set up the charts. But with practice, you'll get faster and faster. Set up the range. It's a range break to the upside. Looks good. Now, we got to check the risk reward. Let's go back to the Excel spreadsheet. Oops, sorry about that. So let's just go, okay, $10 stock, 125 shares, looking for 50 cents of room to the upside.
that better?
So in this case,
how's the audio now?
We're at $13. We need to see at least 50 cents of room to the upside. Oops.
New mic, so
let's say that, okay.
Still tweaking it.
You go at 13.12 when the candle closed over that range break, which is what I would like to call confirmation, candle closing over it. You take the starter of 125 shares. It's at 13.12. We already know where the next resistance point is. It's around 13.83. So you got what, 71 cents of room to the upside? Is this over your minimum amount of 50 cents? Yes. We already charted that thing out. So you take your starter size on it. It starts to push more to the upside, let's say at 12.38. Oops. Right here, this candle. 12.28. Let's say that this candle is where you decide, okay, the trend's holding. Let's draw the trend very quickly. This is the trend. Trend's holding up fine.
Trading.
I'm going to add into the position full size, and let's say for argument's sake, you're doing it right at the high, at that 13.28. Okay. You go 13.28, has room to 13.83. Is this still minimum 50 cents of room to the upside to meet my goal? Yes, it is. So you add the next 375 shares. Your stops are at that 20 cent below your average. Your average is going to be probably around, I don't know, like $13.20, let's say. And then basically as it pushes up into this level, and as it's holding this trend, there's no reason to exit the trade until that trend breaks. You would hit the first target of 13.83. And you'd go, okay, I'm going to sell, let's say one fourth or 1/2 of that trade. So you're locking in 1/4 to 1/2. And then as that area breaks, you see the candle close over there. We already charted out that next resistance of 14.93. You're still holding the stock long. As long as that trend holds, you want to hold it long. You're holding it long, 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 long. You start to see it basing, and then it breaks the trend up here. And then this is where you go, okay, the trend's broken. It's probably going to start to pull back. Let's get out of the rest of the position. Pretty good example from today. The one thing that you got to note is you're going to be in the money here. And what you want to be doing is just moving your stops up and giving it a little bit of room below that trend as it pushes up the entire time.
I screwed that up.
Once it breaks that trend, you're either going to get stopped out.
Don't let a trade go green and then pull back on you and go red.
Just decide to exit because it's going to pull back.
Really stupid on momentum. You have to have a signal that tells you when to get out on momentum.
Hey, Garen, did you record this by any chance? Because I totally forgot to. I explain this every Saturday anyways, and I go in more depth than I build people risk rewards, but also it still is recording. Okay, cool. But that's essentially it, guys. I just wanted to show you a basic example of this, why it's important, and actually how to apply it. FYI, this is how I'm thinking about every single trade. Every trade, this is my mental process. I go, okay, setup good. What's the risk reward? I go, okay. Where's the scale size? Where am I going to add? Where's my stops going to be? And then just moving it up. Let's get rid of the annotations. What is the criteria for sizing in again or not? And we call that adding. The criteria for adding is this trend still holding? So you got to ask yourself, is the volume increasing? A couple things. There's a lot of different criteria, but one of the things is the trend intact? And if you're going long, is the volume increasing?
In any time frame, Eric. Doesn't matter what time. This is price action. Price action is interchangeable to any
intact, it's going higher.
Any time frame.
Volume's increasing, it's going higher. You already determined that it does have room to 1383. Will it get there? We don't know. All we know is that trend is intact and the volume's increasing. The probability of it hitting that level or going towards that level is higher than not.
He trades everything, Dan. Yeah, his Twitter handle is...
Another example of this would be the TLRY that we did today after the actual trade setup. And let's just quickly go to it. Oops, there we go. Same sort of concept, except on TLRY, what we were looking for was just simply this. That pre-market. This trend broke. I said, okay, guys, scale into this trade. It's going to have room towards the 117 spot. If that breaks, it's got room to this high at 119. So we took the trade long. We had the stops at 113. And we just waited. Trend held up, and then we ended up getting our push. The add on this would have been over this range.
That'd be too risky
that
for
range,
me.
You can add into it.
I wouldn't take that add.
This resistance, and then the next resistance is where it had room to, and sell into there. Same sort of concept in practice, except obviously we're looking at $100 and $100.
And this is a what you don't see on the daily. This is a bear flag on TLRY. It's coming down short.
When I look at daily targets,
so
do you look at wicks or bodies?
Like
you want to look at
the other chart.
You want to look at
the other
wicks.
chart was an open range breakout.
Bodies don't mean anything. What is it? If you understand what a candle is, for instance, this is a red candle. A candle represents a range that the stock traded within on that day.
I don't use it anymore.
Low. Red candles open up at the top, they close at the bottom. Green candles are obviously the opposite. They open up at the bottom, close at the top. This is why I don't really care about the body, because it doesn't mean anything. I care about the highs and the lows, because that's actually a resistance level. That's actually a support level. Do I have an example of a breakout when a breakout failed after an ad? Let's try and find one.
He'd set a real type. He'd set
guys,
a real
when you
type,
add, you move your stops up. Obviously,
stop on that yuan. He wouldn't.
From today.
If he added into this, he would put like a 25-cent stop loss or a 10-cent stop loss on it as it was running.
JAGX.
It'd be like a scalp long.
Right here. This is a good example of that. So JAGX, we took it on a pull into the 210 spot long. And what we were looking for was a break of this 230 for continuation back to the highs, right? Whether or not this fits your risk reward, you know, it depends on who you are and how your account is, etc. But here we are at, you know, we're risking 10 cents in this instance to try and make 20 minimum. And then, you know, we wanted to get it to 250. That was the whole idea, but that's the risk reward. We're risking 20 to make, risking 10 to make 20.
So you enter at like 205, 210.
This one never failed.
Risk below $2.
This one never was able to confirm that break of the 230. And when it failed to confirm that break, we moved our stops up and we ended up just getting stopped out at that range. And then it broke the support level. The reason why we had our stops moved up to the range was just simply the trend ended up being right there at that point. Do I ever use trailing stops? Yes. So something like TLRY, when it was running and going parabolic, you can throw a trailing stop on that. Something that like Amazon, like we were playing the calls today into the close. We're looking for 1975 on the common. And let's just go to the 1975 calls. Something like these Amazon calls, you can throw trailing stops on. Because when they do break out, that premium is going to spike. And then sometimes it will yank on you, but you'll get stopped out in the money. Typically, what you want to use trailing stops on are the, well, first of all, if you're going to be away from the screen, throw a trailing stop on it or a bracket order, or something that's going to go parabolic. You want to give it a little bit of room because this is going to give you a much better exit than you try to
Ash Kelton, but you have to understand how to trade options.
But yeah, I mean, that's the basic concept of risk reward.
You guys have any other questions before
you guys?
He shuts down.
I think it's a really good idea to try and put together your own criteria.
Ask the questions now, or else he'll probably be off here. He's been on mic all day for about
every single trade.
10 hours now.
And just, you know, go from there. You may have to adjust it as time goes, which makes sense.
Not like 9 or 8 hours.
Something to think about, and it's something that I think you should apply. when you start applying, and I've had a lot of traders go, hey, you know, Spartan, since I've been using risk reward, my emotions go down dramatically. And that's the whole point of using a system like that. Once you understand and that situation is controlled, then you know you understand you're in full control. You know that your max risk amount is going to be that much, so you're never going to be hesitant to get into something. It also cuts out, you know, you have to be disciplined applying it. It does take time to get there. But the one thing that it does cut out is when you have, like, let's say FOMO on something that's running, you have
the strategy
to go,
I'm using
well,
is entirely mechanical, so it's really helped me out with my
the
emotional side. You know, the trade is what it is, and that's it.
What's the best way to set trailing stop percentages? I would go price, can't range.
The ranges,
what I would do on,
ranges are
let's
built
say
off
that
candles,
you're trading Amazon,
Jarvis.
What I like to do is I like to do this. A good way to set a trailing stop is this. I'll go, okay, this is the channel of Amazon.
This is a nice tip.
The channel range is essentially, we got what? 59 to 53. 53.50. So we got what, like 4.5 points of range. Depends on where you are in the channel. If you're near the bottom of the channel and you understand that has 4.5 points, that you want to give it at least 4.5 points. If you're near the middle, then, you know, go down from that area. You'll know it. You know that channel's gonna have 4.5 points of range. So you got to let it be able to work within that channel so you don't get stopped out.
You're welcome, Eric. Smaller time frames. Well, it's price action.
Anyways,
Jarvis. Any time frame.
I'll show you after this. Insight on that, guys.
But you can see range
everyone
breakouts.
Have a good day. Obviously, here for questions as always.
On any time frame.
Thanks for tuning in.
The larger the time frame, the bigger the move is going to be.
If it doesn't, well,
I can ask Ash Kilton, but I don't think it's more for his students.
Guys, thanks for everything today. Have a good night, and yeah, we'll talk soon.
Okay, I'll show you guys some more on. I'll show you my risk calculation, so you'll get a feel for his and a feel for mine. So let's start with my risk calculation real quick, and then I'll show you my cheat sheet and how it works, and I'll talk about the range breakouts too for Jarvis. You're asking. New to trading, and I have a paper count. Is it okay if I learn to use delay data? If you're swing trading Shobi and you're just practicing, no. But if you're trying to day trade, yes, you have to have live data. Okay, so for example, well, let's look at Nike right now because they just had earnings and they're breaking down right now as we speak. So this is post-market trading, which I can't do, but. So we have the trend, this common trend down right here on Nike. We've got, it's kind of nice that we can do this live. Range right there. Got a range right here. Then we have a range back up to previous low. Yeah, actually, we'll do range on previous right here. So now let's look at the daily chart first. My bottom two charts are dailies. This is the monthly daily, and then this is the yearly daily. So yearly, Nike is bullish. Earnings came out. It's obviously bullish, or it's bearish. So something bad on earnings. Estimated 0.63. Doesn't tell us what the actual is. But we are bullish overall. So I am obviously more bullish inclined on Nike, but because this is earnings, it's played a little different. This isn't like a technical breakdown. Let's zoom out. We got to find, so we found our ranges on the top side. If Nike starts to break out of this channel, which it looks, or this downtrend, which it looks like it's starting to confirm here, and then I think trading hours is about to be over, but the next range is on down here. That's the next range. So we are bearish. This is a bear flag going, but it could reverse back long. The way I would if I wanted to go long into this, the way I do my calculations is I measure from the price that I want to enter at to my stop loss. And this is about $1.25 below range, somewhere around there. Now, if I take a trade with full size at $1.25 stop loss, if the trade goes my way, $1.25 is when I'll make 1-to-1, and then $2.50 is when I'll make 2-to-1. So right at the top end of this range. That's kind of a shitty risk reward. And a better risk reward would be about 60 cents. So 60 cents, right about just over the top end of this first range, would be 1-to-1, then 2-to-1, and then 3-to-1 right about here. So ideally for a 3-to-1 trade on this, if we were going long, we would want a 60-cent stop. Now, I don't like sizing in full into my trade immediately because it could go wrong and then you're losing a lot of money. So if I want a 60%, or if I want a 60-cent stop loss for my initial trade, I bring over my calculator, and this calculator calculates basically you put in your portfolio amount for the intro account of Tradenet, which is what I'll be trading with when I go live. It's a $700 account. I'm risking about 7% of my portfolio per trade, which is $43. So if I took this trade and it went the wrong way on me and it hit my stop loss of 60 cents, I would lose $43. But I'm not going to size into this heavy on the first trade. I will do a half of that, which would be a $1.20 stop loss. So 60 cents, 72 shares divided by 2, we'll call that 35 shares. Now we'll just do 34 just to be even. So I would take a trade here, buy 34 shares here. Now it's not going to do it because this is post market, but we'll pretend that it is. So if this stock starts to go bullish, I would then stack into, as the candlesticks go farther and farther, and it starts to confirm an uptrend, I will get into it again for another 34 shares, which will be my final entry of 60 cents stop loss. So every 60 cents the stock moves, I will be making a 1-to-1 trade. Now to visualize that, we can actually use Fibonacci retracements. Well, let me show you in TOS because it can be better seen in TOS. So this is my other trading software that I use. Drag it over. Okay. Let's go to Nike. All right. So I use Fibonacci extensions. I've customized my Fibonacci extensions to do this for me. And we're going to do a 60-cent stop loss. So do our ranges real quick. I'll just maximize the screen. And I forgot my maximize button. Maximize screen. Okay. Let me add 50 bars to the right. Okay. So Fibonacci extension. This is $82.24 up to $84.80 something. So I'm going to take my extension lines and click it right about here. Drag it back down. Boom. There's a visual representation of my risk reward of the trade, and that should be about 60 cents. If I take my trend line tool and I draw up to here, yeah, that's about 60 cents right there for a 1-to-1 trade. Now, again, I'm not going to size into this heavy. How do you find the range? It's purely off of the candlesticks, high and lows. So these candlesticks are bouncing here. So this is a range. I'm looking at the high and the lows. So all these candles are hitting and bottoming out right here. And then I've got candlesticks touching right here. So this is a range. It's bouncing in between this position right here. It's also on a downtrend. So what I'm looking for is a break of a downtrend and it to start to go long, and I'll stack into the trade as it goes. So again, I'm not going to take a starter size of 60 shares. I'm going to do 120 shares, which is somewhere around here. Now, here's the kicker to not losing money. On your starter size, I'm already half in my. When I take a starter position, I'm usually half or thirds into my trade, depending on the setup and what I'm wanting to do. If this stock breaks down and it goes short, and it hits my stop loss down here with 32 shares or 34 shares, whatever it was for the $1.25 stop loss, because that's what we're at right now. Let's say I bought at 32 shares here. This, yeah, about $1.28 right here. So again, back to the cheat sheet. $1.25 stop loss, 34 shares. If the stock comes down this way and touches my stop loss, I will lose $43, which is 7% of my account. I would never let it do that though, because I know if this thing breaks down and breaks range here, and it also breaks this downtrend right here, so we're building kind of a flag right here. This is a you can build the flag off of the high and the lows and the downtrends. If it came down to 80, if it got below 81.80 flat, 81.80, I would stop out. So because I'm only in half size to start, and then I stop out halfway to my stop loss, I'm only losing a quarter of that total $44. So if I got stopped out on this trade, I would only lose like $10 instead of $40. So by sizing in thirds or halves when you start your trade and your initial entry, you minimize the amount of risk you're taking on your portfolio in case the trade is wrong, because you don't want to go in full size immediately right off the gate because there's a chance that you're wrong. You want to let the trade start to move your way before you get into full size. And as you can see, it looks like it might be breaking range. So this candle has opened below these. This is the first candle to make new lows. So this is short. I'd be out of this trade right now. And I would take say my entry was here. It's a 50 cent loss on $1.25 trade stop loss. So it'd be about a $9 loss right there. If I had gone in full size at 60 cents, I would be down $30. I'd be down almost, about 75%, 50 cents to 60 cents. Yeah, over $34, almost 80% of my risk. So by sizing in half, I am only losing $10, which is, what is $10? Is that like 2%, 2.5%? Yeah, with sizing in half and waiting for the trade to confirm, I only lost 2.5% of my portfolio. If I had sized in full, I would have lost probably 6% of my portfolio. Yeah, somewhere between 5 to 6%. And you can see, I built a calculation that tells you if your trades, how many trades you can take before you blow up. Trading at taking a 6% loss every single trade that you make, you will blow up your account in 17 trades. But if you only lose 2.5% of your trade, or 2.5% of your portfolio every trade, you can trade 40 times, almost over double, before you blow up your account. So this is portfolio management and portfolio protection. By understanding risk management and understanding how to size into trades correctly, you minimize the risk that your portfolio is exposed, and you're able to not blow up your account. if you see my 1 month review video, I made 93 trades in that account. My biggest loss was only $53. I spent like $400 in commissions. There was never a single trade that I took that I did not use this cheat sheet, and I didn't calculate my risk before I got into the trade. And by doing that, I never had a massive loss. I never blew up the account, technically. I mean, the account grinded down, but it was never a massive, like 50% loss in one trade. Yeah, and then that's the next point, Eric. You have to be, the higher win percent you are and the more accurate your strategy is, the better that is for your risk management. So if you have my win rate on the last account was like 36% win rate, which means I would have to, each trade I made would have to be a 3-to-1 trade for me to be profitable, on top of not having commissions. If you have a win rate of 50-50, you can afford to take 2-to-1 trades and have lower risk and lower downside and still be profitable. So the higher accuracy your strategy is, the better and the more you can risk. And typically, well, it just depends on the strategy. But I can show you some examples for those of you. The benefit of this cheat sheet is it scales with size. So as your account grows, if this account grows to $1,400 and I'm still risking 7%, which I probably wouldn't, I would probably drop it down to 5%. I'm now making $92 per trade. So you can look at RPT as not only your risk per trade that you could lose, but you also look at it as your profit potential. So if you're aiming for 3-to-1 trades, take this dollar amount times 3. So 92 times 3, $270 per trade on a 3-to-1 trade. Now, if you have a $10,000, let's do $5,000 account, you're now risking $341 per trade. And every time you readjust this calculator, it will readjust the sizing and the amount of shares that you need to be buying for the trade and for your stop losses. So as your account grows, the amount of money that you're going to be making is also going to scale with it. And a lot of traders focus on, I want to make $50 a day or $100 a day or $500 a day or $3,000 a day. I don't care about that. I don't care about the dollar amounts. For me, it's all about percentages. If I can make a consistent 5% a week or 5% a day or whatever that percentage is that I end up becoming profitable with, if I can repeat that day in and day out, it will grow exponentially. People that focus on dollar amounts, you're essentially risking less per trade every time your account grows. So, if you want to risk $50 a day on a $700 account, that's about 8%. But let's say you grow that account to $2,000, but you still want to risk $50. You're now only risking 3% of your account, somewhere around there, 3% of your account. When you've got a $10,000 account, you're risking like less than 1%. Yeah, it's 0.5% of your portfolio, which again, it ups the amount of trades you can take before you blow up your account. But if you graph out your portfolio growth, it'll start to curl over. Your portfolio growth will get slower and slower as the account grows. So you kind of have to look at it as time put into your trading. Theoretically, you should get better as you trade. So having a portfolio curve that is declining or slowing down is not the way you should do it. It should be increasing as you grow the account. So you always want to try to be risking a set percentage no matter what. Ideally, they say 1 to 3%. 3% if you're really good. I mean, there's some people that can do 5 or 10%. It depends on the strategy. But ideally, you want to risk 1% per trade. And on a $10,000 account, you're risking $94 per trade. You have 100 trades to screw up before you blow up your account. That's a very, very good percentage, and number of trades you can take before you blow up your account. And actually, well, now that we look at it, I traded 93 times before I blew up my last account. So my down curve was probably 1% per trade, negative 1% per trade almost. Yeah. So each trade I took, my account was going down. If you were to draw an averaged line of the portfolio curve, it would have been negative 1% per day. Yeah, and you have to calculate commissions. And the calculator actually calculates commissions as well. So with small accounts, you have to risk more because you have to pay for commissions. So I have to risk 7%. I can't go in. This is my biggest mistake when I went into my live account, is I tried to risk 3% of my account, which is $15. My commissions are $5. So even if I make a one-to-one trade, I'm still immediately down 33% on my trade. So you have to trade a little heavier with a small account, which means you have less trades before you blow up. But you can also calculate your commissions. So some commission or some softwares are $5 per trade, which brings your risk per trade down to $29, which is not acceptable. You need to be around $40. You could probably do $30, but $40 ideally per trade. So $5, this would probably be like 10%, somewhere around, yeah, 10%. And then you can also adjust the number of entries and exits that you do. Right now I'm practicing 2 entries, 2 exits, but it just depends on the person. Do you guys have any questions on how I size and how this calculator works? I can show you a longer time frame for range breaks and trend breaks and stuff like that. Let's look at a larger time frame. So we'll stay in TOS because it's a bit easier. I need some water. Let's look at Facebook. Facebook had a fantastic range break this past month. So, oops. So Facebook has been, if you've been following it, it's had a downtrend. And ignore these CNBC signals. Hold on. Off. Okay, so Facebook has been on a downtrend on the hourly, actually on the daily, for the past month and a half. And you can downtrend, might be easier to do this on the daily. So daily, let's look at the daily. You can clearly see the range here on the daily of Facebook. So we have a price line here. Wick touch, bottom touch, wick, another wick. It fails here. This is actually a price action indication of reversal right here. You can't really see. It's better to see on the 3 minute or in the 30-minute, but so you would draw a downtrend. Probably somewhere like this. So this would be the downtrend on the daily, and you're going to wait for this trend to break. So the bigger the time frame that you have a trend break, the bigger the move is going to be, but the slower the move is going to be. So if you're trading on a 1 minute and a 5 minute chart and you're looking for range breaks and trend breaks, and you're high speed trading, those moves are going to be much faster, and you're going to need a lot less time for confirmation. This was something that took me a while to understand and figure out. Was, if you're trading low floats, if you're trading under 10 million float stocks, these penny stocks, dollar stocks, $10 stocks, when they break out and they have massive volume, they'll move real quick. They'll move in an instant, and as soon as they break the range, you buy and you get in. With these higher cap stocks and the large caps, like Facebook, and especially when you get into like daily range breaks, you want to be a little slower on your entries because it could be a fake out. It could be not confirmed. So my biggest issue when I started studying Spartan strategy was I come from low float, which is trend breaks, you buy in right there, go. That's not the case with these larger caps and the slower moving stocks. For that reason, I usually wait for, if I'm trading a daily range like Facebook, I would probably wait for a 1 hour candle close or a 30-minute candle close, which would be 3 10-minute candles above range or one of the hourly candles above range. So this is the hourly chart on Facebook, and you can see it's a common downtrend. And we have a fake out here. So this goes, it goes short pre-market and it fails and it comes back to trend. To me, this is a signal of the bottom. This is a signal of reversal long. I use that as a price action signal, and I like 30-minute charts for seeing those better. But if we go over, we get a range break right here. So this downtrend is, the range is breaking right here. There's a couple ways you could enter into this trade. You would wait for this 1 minute or this 1 hour candle to close, and you would probably buy in somewhere. You would have some kind of indicator or signal or a Fibonacci ratio to buy in dip here for a starter. When it breaks range again here, you buy into it full size here. So we can do the calculations real quick. Well, there's two ways you could do it. Let's go to the 10-minute. No, we'll stick to the hourly, and then I'll show you the 10-minute. So I would want to buy in somewhere at the 50 fib. So the way you could fib this is from high and low of that candle. Typically flags, very good bullish flags, will pull back to the 61 fib. This line right here. So I usually try to buy into strong flags at the 61. So, you know, theoretically, if I wanted to do this right, and then over right there. So we get our big run up flag, closes strong. I would buy in starter here, and I would want to risk below this candle. So what is that? 61 fib down to $1.34. We'll say $1.25 just to make it even. I'm going to drag this up. Actually, I'm going to draw a trend here. Kind of can't reach it. We'll just call it $1.25. So we'll draw my Fibonacci extension up and back down. Boom. There's my risk reward graphically. And I'll give you guys my setup for that R&R as well. You can see it. So let me turn if you guys want to copy paste this real quick, or it's actually in the Discord. If you trade on TOS and you want to set up this graphical way to do R&R, you can use it. In the Discord, I've got it posted under Garen's trading position sizing. I've got a picture right here, so you guys can copy this if you want to set up your Fibonacci extensions the same way. But right now on the starter, let's drag that a little bit. So I always try to get my stop loss a little bit below that. That's probably actually, no, that's good. So we've got the range break and the flag break. We would enter somewhere right here. 1-to-1 trade is going to be the next run up. We're already at 1-to-1 on the starter size. This was a swing trade for me because the range that this stock can move is back up to this high, this previous high on this channel. So, and that's exactly what it did. It ran all the way back up to this range on the daily and topped out and failed. And now we're in a consolidation period, bouncing back and forth. So my ultimate, and I missed this trade. I was watching Facebook all week to catch this, and I left to go to lunch or something, and it broke out, and I missed it. I was very upset that I missed this trade. So yeah, 3-to-1 would have been right here. 4-to-1 was at the top end of the daily range. Now, if I sized into this heavier, as it confirmed, so the confirmation for me after this to size in again would be on the 10-minute. So the hourly is already confirmed. Now I can go down into the smaller time frame and start trading it that way. So let's go to the 10 minutes. Change that to 15 days. Yeah, so right here. So this is the same thing, just on the 10-minute. We get the big bull flag breaking the trend, pulls back. We enter into it low here, and you can see my EMAs confirm this. My EMAs hold the entire time, so this is also giving me confirmation that it's bullish. My second entry would be the break of range here. So I would probably size into this again, maybe for double size or ×2 size here, which would bring my average down to half, and then my stop loss would have to move up because, you know, you're averaging up. So your stop loss is gonna, your average price is gonna move up as you size into something, but your R&R is gonna get smaller. So confirmation is hard to teach, Stevo. It depends on the chart time frame and the setup. It's something it's one of those things that you just have to get screen time for. So now if I sized into this heavier, this entire trade, I would get out of it because it's a day trade, and this is way too heavy of a sizing for a swing trade. But if I got in, if I let this run for the day and then like took half profits or 75% profits at the top end just to be safe in case, you know, we do have a gap down, and this is where options comes into play too. You could buy a protective put, which is a short position from options basically on Facebook, and you can hedge against the downside if a stock is breaking down and you're trying to swing it. But I'm not gonna get into options because honestly I don't know enough about them other than the basics. So I would probably take 75% profits here. Sorry, I need a drink real quick. I'm losing my voice. Okay, so I would take 75% profits here, and you can calculate what that profit would be. This is a 75-cent stop loss with an average. If I took 75% profits, that's a $2 run, 75 cents. Yeah, let's do the calculations real quick. So that's $2. 2 divided by 0.75, that's the stop loss. That's a 1.5 to 1 trade. Times 40, that's the total amount that it would have been. Yeah, and I would have took 75% of that, so I would have locked in a 1-to-1 trade just on that day trade, and I would have swung another 25% of it for the next day. So it ended up breaking pre-market and post-market and running up. So it finally topped out. I would have taken profits probably right at the gate opening bell just to be safe for that remainder. So the remaining 25% would have been $3.21. I'm not going to calculate that, but it would have been probably a 2-to-1 or 3-to-1 trade at that point. So that's how I calculate risk management. All of every position I take and every trade I take, I use this calculator, and all I really do is I measure the distance between my entry and where I want my stop loss to be, and that's pretty much it. I kind of went long-winded on this, but it's all pretty much the same. Let me look at a trade that I took today that I actually made money on. AMD. Yeah, actually AMD was a good trade. And TNDM. These were trades that I took today. Where was my entries? That was a bounce play. TNDM. I think AMD was a better technical break. Yeah. This is a picture perfect play. The same exact play almost on Facebook. Let me show you. All right. So this is the 10-minute chart. AMD again, bullish on the daily. And but it was bearish on the 10-minute, but I still took it long for profit. Trend. Okay, so I was fighting AMD all day. Each one of these little arrows is a buy and a sell. I actually lost a bunch of money in the open of this. I think I took it long on the open and then sold it for a loss, and then took it long again here, bought it again, and then broke even here because it failed. I thought it was reversing, and then I took it again long here on this, and then it trend broke and I got out. It was I kept trying to trade it and kept getting burnt, but I knew that the longer it went down, the more of a chance it was for me to make profit on the upside. So I eventually took it long. And some of these losses were only like $5 or a couple bucks. Yeah, $3 loss on AMD, 70-cent loss, $16 gain, $5 loss. $5 loss and a $2 loss. Yeah, I kept fighting it and trend trading it, but ideally the good trade would have been off of these candles, but hindsight's 2020. So downtrend all day, and then it eventually broke this trend. The 5-minute candle breaks trend, pulls back, and starts building lows. I sized into this, and I sized into it kind of light. I could have gotten heavier into it. Basically, I just measured below previous low down here. About a 21-cent stop loss. So I think I did a 20-cent starter. Let me pull up my cheat sheet. 25 cents, 200 shares. Actually, no. Back, because that's 7%. Commissions are $1.50 for me. 25 cents is $172 shares. So what I bought in here long, and that's where I did right here on this candle. I bought in long, and then my stop loss was just below this. So if the stock broke down and broke this low, this range, this is a range right here. There's all kinds of ranges that you have to play off of, and you have to see. That's a range. From here to here, this is a range that it's bouncing on. I bought on the low end of the range, stop loss just below it, but my total stop loss was like way down here. So if the trade, this is my initial starter entry, if it went the wrong way, I wouldn't lose 7% of my portfolio, and I'd only lose like 2%, which actually I think this somewhere would have been like $3 or $5, something real small. On the upside though, when it broke, I actually missed my second entry. I would have sized in here for another after the break of 55, and I would have brought my stop loss up again for a let me see if I can do the graphical. I'm not sure. Chase that. Actually, trim-based line extension. Let's see if we can do this. Yeah, so something like that. I'd have to customize it, but yeah, you can use the Fibonacci extensions in here as well for R&R. Yeah, and then I just hold it until it breaks trend. So The exit signal on this was, well, that's a range too, I guess. The price action, so I basically just drew a trend line off of these lows, these wicks that we're building. And if it broke here and I got out. Actually, I think I screwed up. I had a mixed order. I had a $2 loss on this, but yeah, it failed here. Ideally, it would have bounced off trend and kept going back up. So that was the green trade for the day, and then it just kind of bounces in that range for the rest of the day. Yeah, that's... Hopefully that's paper account Sonic. Do you guys have any questions? And again, you can download the cheat sheet in the Discord. Cheat sheet and the sizing calculator are in here. So this is the Fibonacci setup. And this is the position sizing cheat sheet. You can load it into Excel or Google Sheets. I've just switched over to TradingView. I'm just testing it out to see what it's like. So far I'm liking it because I can set alerts. So because I'm trading trend breaks, I can set alerts off of the trends, which is really nice, which TOS can do, but the best feature about these trend breaks is I can say add alert and I can do once per bar close. So I don't care if a stock touches a trend line. I want to know if it's breaking the trend line. So by using a 5-minute time, the strategy I'm working with is off of a 10-minute time frame, but I found that if I use a 5-minute time frame and I use once per bar close, it gives me a 5-minute head start on confirmation of these trend breaks. So I can click this when the candle crosses and closes above or below this trend line, I'll get an alert, and that gives me an extra 5 minutes to set up my R&R and figure out my calculations and get into the trade for my entry, and then take it after that. So I'm really liking TradingView for the alerts. There's a link in the description, Ash Kelton, for the Discord. How much would you risk per trade? Depends on your portfolio and your risk management. I would like to be able to only risk 3% of my portfolio, but with a $700 account, I have to risk 7% because I want a minimum one-to-one trade of $40. My minimum profit should be $44 or $40 because after $5 commissions, that's about 35 bucks profit. E-roll, no, because it's not emotional at all for me. It used to be emotional, but I have signals that specifically tell me when to get out, Earl, so I don't care what the stock does. I have alerts set that tell me when to get out of the stock. For AMD, I had an alert set that told me to exit the stock. Actually, I didn't even do that. I had stop losses. So that's another thing I didn't show you, and I wish I could show you this live. Let me throw up a sell order. We'll just pretend. So let's say that this is my stop, modify, and we got the trend break. This was the trend break down here. Trend break, and we bought in here somewhere. Let's say this blue line is our average for our starter. Stop loss down here. As this trade went for the next few minutes, I would just grab this stop loss and move it up. I would put it right under the candle, right under the last candle. So if the chart looked like this, boom, broke, I would buy into it. My stop loss would be down below these candles, these low wicks right here. I don't know if you guys can see them. You should be able to see them. The low wicks. Next candle, it's going green more. It has also broke a range. You might not be able to see it if you're not familiar with it, but there is a range right there. These wicks are bouncing off this range. We have a wick bounce there, and then we have a range right there as well. So whenever I get a range break or a big candle, I will move the stop losses up to the next range. So right now we're on this range. This candle has broke and confirmed this range. So my stop loss is going to move up to the last candle. We're going to go over, and it's holding, so it's confirming just below that. And if I took a loss here, it would only be like a half a point loss, or like half a percentage loss. So I'm almost already at a 1-to-1 trade, and then it bounces and then it rips. So as soon as it rips here, moving my stop loss up just below this range, and I can't do that because I gotta get rid of this buy. But move that up there. Just do it. No, just okay. Hold on. Sell. And whatever. That works. Close that. So our average, what was our entry? It was like right there. That dotted line is our entry. Then our red line is the stop loss. Okay, so this range right here, my stop loss would then be moved somewhere inside below the previous range, because the stock can run up and then pull back and retest the range. So you always want to have your stop loss, so you don't choke your trade, you always want to have your stop loss lower than the previous range. Now it starts to build lows here. So at this point, it's building a flag. This is a flag on the 5-minute, and I can see that after 2 candles. So I would move my stop loss up to, I would take half profit. I would have a half stop loss here. It goes long, pulls back, and breaks. And actually you can see that this arrow right here is my sell signal. So I took profits right here as it broke back down the range, and then once this candle opened, I took my remainder profits. So the trade just failed, and it did. I was expecting it to come up to VWAP, which is my green, but it didn't. It just came and curled back down. But that's, I never, once the trade is going, I move my stop losses up. So that way, even if the trade breaks trend, I make profit and I don't worry about it. So you were asking, taking Xanax before the morning open? No, because it's all just mechanical to me. It works and it goes and it doesn't. Like I can't predict what the stock market's going to do, and I can't predict what the chart's going to do. I just have to play it and have a strategy, and it works or it doesn't. That's it. That's a good quote. Never clocked. All battles are won before they're ever fought. That's true. Yeah, I pay $6 a month for real-time data of Nasdaq's NYSE and ARCA. So you have to pay $2 for the live data. Yeah, you have BATS is just the freemium, the free version of TradeView. You have to pay for the live data. Yep. See you, Spencer. All right, I'll take like one more question, and then I gotta shut down the stream and take a break. I've been sitting here since 8 o'clock in the morning, or 9 o'clock in the morning. All right, guys. One day I'll trade Forex Pharaoh. Not anytime soon. Yeah, I saw that, Zen. It's really nice. I don't do oscillator trading, but yeah, I set crosses on my EMAs, which is also really nice. So that's another way I could get into a trade, is EMA cross. It just depends on the setup. See you, Dylan. It's under Garen's trading category, Jervis. So the first thing you should do when you get into the Discord is just minimize all of the kind of messing up actually. Minimize all of the channels, and it's under Garen's trading right here. We have Garen's trading, Ryan's trading, Skylar's trading, Spartan trading. These are all specialist traders of the community that help people out. Spartan trading is the guy that you saw on Mike originally. So if you have any questions, you can ask him questions here and ask Spartan. But for the cheat sheet, it's under Garen's trading, risk management, or sorry, position sizing channel. I'll put in a link in the announcements. So just click the announcements up at the top and click position sizing. That link, it'll take you to it, and you can find it in there. It's in the description. Strung Audi. Strung out in Y. Oh, it's probably, you have to go to the YouTube. Strung out. It's see if I can find. Here, I'll link the YouTube for you, or I'll just post it. I'll post the link in to it. That. There's that. Discord. All right. Yeah, I'd have to sign an NDA if I went Twitch affiliated, and I wouldn't be able to stream on YouTube anymore. And all my viewers are from YouTube, so maybe one day I'll be a Twitch affiliate, but not anytime soon. Swing for an AMD? Not quite yet. It might be able to pull back a little bit. Alright, I'm going to shut down the stream, guys. Hope you like that little talk on R&R and all that.